Disclaimer.
Silver is trading at $80 per ounce right now, down from $121 just 6 days ago, and the timing could not be worse for the Treasury. While Scott Bessent scrambles to manage a massive debt rollover, Kevin Warsh's move at the Fed is sending a shockwave through the paper markets that no one saw coming. The system is cracking, and the gold and silver revaluation is no longer a theory. It's the only exit plan left. Here's what happens next. Right now, as you're watching this on February 5th, silver is hovering around $80 per ounce after one of the most violent crashes in modern commodity history. If you follow precious metals, you know that's roughly 20% below where it crashed from just 6 days ago. But here's what you probably don't know. Last Thursday, January 30th, an $18 million trading position evaporated in minutes. This wasn't some crypto token disaster. This was silver, and what happened reveals an exit plan so precise that once you understand it, you'll never look at commodity markets the same way. Here's the timeline that matters. At 10:30 a.m. Eastern on Thursday, January 30th, President Trump officially announced Kevin Warsh as his nominee for Federal Reserve Chairman. Within the hour, silver began a free fall that would erase 31.4% of its value by closing bell. But the metal had already been trading with extreme volatility before the announcement, and sophisticated players had positioned themselves perfectly for what was about to unfold. Silver opened that Thursday near $121.64 per ounce, up nearly 250% from 12 months earlier. Every fundamental indicator pointed to continued strength. China had locked down 60 to 70% of global refining capacity through export restrictions, effective January. First, industrial demand from solar and EVs was consuming supply faster than miners could extract it, and the metal was entering its 5th consecutive year of structural deficit. Then, the cascade began. According to data from Hyperliquid and other platforms where silver perpetual futures trade, $70 million and $52,000 in positions were forcibly liquidated over 4 hours. Here's the number that reveals everything. 99% of those liquidations were long positions. These weren't speculators betting on a crash. These were traders positioned exactly where supply-demand analysis suggested they should be. One Hyperliquid Whale watched $18 million and $13,000 disappear as automated liquidation engines sold into a collapsing market. You went to bed with an $18 million position backed by rock-solid fundamentals. You woke up completely liquidated, not because your analysis was wrong, but because you didn't have institutional infrastructure to survive a coordinated volatility spike. And that's exactly what this was. Volatility engineered through margin changes and perfectly timed with a Fed nomination that created narrative cover for forced selling. While retail traders got margin calls they couldn't meet, a completely different set of players executed the opposite strategy. Institutional entities with Federal Reserve credit lines, authorized participant status for ETF creation, and physical custody infrastructure that retail can't access, they were taking physical delivery at crash prices. 3,100,000 ounces of actual silver, not paper contracts, taken into custody at $78.29 per ounce, the absolute bottom. The same institutions that participate in Fed liquidity programs, that have Treasury relationships, that arrange billion-dollar credit lines with phone calls, they were loading physical metal while retail accounts were being automatically liquidated. This is the exit plan operating in plain sight. Now watch what happened next. Silver crashed from $121 to $73.50 by Thursday's close, a devastating $48 drop that made headlines everywhere. Every outlet ran the same story. Retail got burned chasing momentum, the bubble popped, fundamentals didn't matter. Except by Tuesday, February 4th, just 5 days later, silver was trading at $91.72. A 40% rebound in 5 days. If this was genuine demand destruction, if fundamentals had changed overnight, price wouldn't recover $18 per ounce in less than a week. But fundamentals didn't change on January 30th. That 5th consecutive year of 200 million ounce deficit, still there. China's export restrictions removing 60 to 70% of refining capacity, still in effect. Industrial demand consuming 60% of annual supply, growing stronger as energy transition accelerates. Silver lease rates above 8%, signaling extreme physical tightness, still elevated. This wasn't demand destruction. This was engineered liquidity flush designed to clear leverage retail while leaving the supply-demand imbalance intact. Institutions that took delivery at $78 gained 16% in days and positioned for the real move coming when this deficit becomes impossible to ignore. The real exit plan isn't retail traders liquidated at the bottom. They exited involuntarily. The actual plan belongs to players who used engineered volatility to accumulate physical at artificially depressed prices, understanding the structural shortage guarantees higher prices ahead. And the Kevin Warsh nomination that provided cover, that creates constitutional tension between Treasury policy and Fed independence we haven't seen in generations. But that conflict runs deeper than one day's silver crash. It's about forces that will make this volatility look tame compared to what is coming for dollar credibility over the next 6 months. What happened January 30th wasn't an accident. The Chicago Mercantile Exchange had raised precious metals margin requirements on December 29th and 31st as prices surged, forcing traders to post significantly more cash just to maintain positions. But real damage came when Warsh's nomination hit at 10:30 a.m., triggering algorithmic selling that accelerated into forced liquidations across leveraged platforms. The physical market tells you everything about whether this reflected genuine dynamics. While paper prices collapsed, physical premiums exploded. Dealers couldn't keep inventory. Websites showed sold out everywhere. Mints reported overwhelming demand stretching weeks into the future. Institutional buyers took delivery of massive tonnages from exchange warehouses at prices $20 to $30 below where physical retail products traded. When paper divorces from physical that dramatically, when you can't buy a coin anywhere close to futures settlement prices, you're not watching market forces. You're watching mechanics exploited by participants who understand timing built into exchange margin requirements and forced liquidation protocols. This is the exit plan they don't discuss on financial television. The system isn't rigged to prevent retail profit. It's designed so when markets move violently, retail exits at exactly the wrong moment, while institutions with superior infrastructure accumulate at optimal prices. The entities that accumulated 3 million ounces at $78 understood something the $18 million whale didn't fully appreciate. They knew margin requirements are a tool, Warsh timing is a catalyst, and forced liquidations create temporary dislocations that have nothing to do with whether physical metal is actually available at quoted prices. As of this morning, February 5th, silver trades around $79 to $80 after giving back some recovery. The volatility isn't over, but players who understood January 30th aren't panicking. They're watching supply deficit math that didn't change, monitoring China's restrictions that didn't disappear, calculating what happens when industrial demand that won't decline meets mining supply that can't increase fast enough. The exit plan is simple once you see it clearly. Accumulate physical when engineered volatility flushes over-leveraged paper positions. Hold through chaos while retail sells to margin clerks. Exit into strength when supply deficit becomes undeniable and new buyers chase higher without having accumulated at optimal levels. January 30th was Chapter 1, executing in real time. The question isn't whether to abandon silver's fundamentals. Those remain intact. The question is whether you understand leverage dynamics well enough to recognize forced liquidation for what it is, temporary dysfunction, creating opportunity for those who see mechanics clearly, rather than marking the end of a structural shortage entering its 5th consecutive year. Yesterday, February 4th, Treasury Secretary Scott Bessent sat before the House Financial Services Committee for what's supposed to be routine testimony about financial system oversight. Instead, the hearing devolved into shouting matches and personal attacks that revealed something far more significant than political theater. The Treasury and Federal Reserve are on a collision course that threatens to expose the entire dollar-based monetary system as structural weakness, just as physical silver markets are signaling an unprecedented supply crisis. When Representative Maxine Waters pressed Bessent on whether he would support strong dollar policy, he gave the expected answer, "We always support a strong dollar policy." That's the line every Treasury Secretary recites, because admitting you want a weaker currency would trigger immediate capital flight. But here's what matters for silver investors. When Waters pushed further, asking if Bessent would draw a line against the president removing Federal Reserve governors over policy disagreements, he refused to commit. "I'm not a lawyer," Bessent responded, deflecting to wait for the Supreme Court ruling on the Lisa Cook case. Think about what that non-answer reveals. The Treasury Secretary, who supposedly supports Fed independence and strong dollar policy, won't rule out political interference with the central bank's decision-making. Meanwhile, Kevin Warsh, the man nominated to run that same Fed starting in May, brings a track record so contradictory that markets literally don't know whether to price in hawk or dove when his confirmation hearing approaches in March. Here's Warsh's actual history, not the sanitized version you're getting from financial media cheerleaders. During the 2008 financial crisis, when unemployment was spiking and the economy was collapsing, Warsh kept warning about inflation that never materialized. In June 2008, with Bear Stearns already dead and the financial system clearly breaking, Warsh told his Fed colleagues that inflation risks continue to predominate as the greater risk to the economy. Not the housing crash, not mass layoffs, inflation that wasn't actually happening. Even after his inflation predictions proved completely wrong, Warsh didn't adjust his worldview. He just invented new justifications for the same tight money stance. By 2015, with inflation still subdued and employment still weak, he was making arguments about Fed policy that economist Larry Summers called the single most confused analysis of monetary policy I have read this year. This wasn't a one-time mistake. This was someone so committed to hawkish orthodoxy that facts couldn't penetrate the ideology. But now Warsh is suddenly talking about cutting rates aggressively while also shrinking the Fed's $6 trillion balance sheet. He's citing AI-driven productivity gains as justification for lower rates without inflation risk. He's criticizing Jerome Powell for not cutting fast enough. This is the same person who resigned from the Fed board in 2011, specifically because he disagreed with balance sheet expansion. And now he's positioning himself as Trump's rate-cutting champion. Let me translate what this schizophrenic policy stance actually means for markets. Warsh wants to cut rates to satisfy Trump's demand for cheaper borrowing costs and boost economic growth heading into election cycles. Simultaneously, he wants to shrink the Fed's balance sheet dramatically, selling bonds back into the market, because he believes the Fed's asset purchases since 2008 have created moral hazard and distorted capital allocation. Here's the problem that Wall Street analysts are too polite to state bluntly. Those two goals directly contradict each other. When the Fed sells bonds from its balance sheet, that pushes long-term interest rates higher by removing a major buyer from the Treasury market. So you'd be cutting short-term rates while driving long-term rates up through quantitative tightening. The mortgage rates Trump desperately wants to lower, they track long-term rates, not the Fed funds rate. Warsh's policy prescription would make housing more expensive while claiming to ease financial conditions. This isn't theory, this is basic bond market mechanics. And silver markets are already pricing in the confusion, which is exactly what that January 30th crash was about. When Warsh's nomination hit the wires, traders faced an impossible question. Do we position for the hawkish balance sheet reduction that strengthens the dollar and crushes commodity prices? Or do we position for the dovish rate cuts that weaken the dollar and support precious metals? The answer was, liquidate first, figure it out later, which is why 99% of forced selling came from long positions that were fundamentally correct, but couldn't survive the policy uncertainty. Now let me show you why this is Scott Bessent's absolute nightmare scenario, because the conflict here goes far deeper than technical monetary policy debates. By tradition, the Treasury Secretary and Federal Reserve Chairman dine together weekly. These aren't ceremonial lunches. These are the meetings where fiscal and monetary policy get coordinated, where dollar strategy gets discussed, where the people actually running our financial system hash out their differences before markets force their hand. Imagine those dinners starting in May when Warsh takes over. Bessent sits across the table from a Fed chairman whose entire policy framework contradicts everything Treasury needs to accomplish over the next 2 years. Bessent wants, actually needs, a weaker dollar. Not weak enough to trigger capital flight, but depreciated enough that American manufacturing becomes competitive again, that our exports become attractive in global markets, that multinational corporations stop hemorrhaging production overseas because labor costs in the United States are denominated in an overvalued currency. That's not speculation about Bessent's preferences. That's basic economic logic for anyone prioritizing manufacturing revival and trade balance improvement. A strong dollar makes imports cheap and exports expensive. It destroys domestic industrial competitiveness. It's great for financial asset holders and terrible for workers in tradable goods sectors. Bessent knows this, Trump knows this, and everyone involved in the Eat America First economic agenda knows that currency valuation determines whether reshoring manufacturing is economically viable or just political rhetoric. But Warsh's entire policy framework points toward exactly the opposite outcome. When you aggressively shrink a $6 trillion balance sheet by selling bonds into the market, you're draining dollar liquidity from the global financial system. That makes dollars scarcer. Scarcity increases value. It's the most basic supply-demand relationship in existence, and it applies to currencies just like everything else. Warsh's balance sheet reduction creates structural dollar strength that directly undermines every policy goal Treasury is trying to achieve on trade and manufacturing. This is Bessent's nightmare, sitting at those weekly dinners unable to coordinate policy because the Fed chairman's primary objective produces the exact opposite of what Treasury policy requires. They can't both succeed. Either Warsh's balance sheet reduction strengthens the dollar and destroys Bessent's manufacturing competitiveness agenda, or Bessent somehow convinces Warsh to abandon the hawkish stance that got him nominated in the first place. There's no middle ground where both policies work simultaneously. And here's what makes this particularly explosive for silver. The market knows this conflict exists. Sophisticated traders understand that either Treasury policy fails and the dollar stays strong, crushing commodity prices, or Fed policy pivots away from balance sheet reduction to accommodate Treasury, which signals that dollar credibility is subordinate to political objectives. Neither outcome is stable. Both create the kind of uncertainty that triggers the volatility we saw on January 30th. Except now it's going to last for months as markets try to figure out which institution actually controls dollar policy. Now let's talk about what the physical silver market is actually showing, because this is where theory meets reality and the contradictions become impossible to ignore. According to TD Securities analysis published last fall, London's free float silver inventory, the metal actually available for immediate delivery had fallen to approximately 155 million ounces. That's enough to cover roughly 6 weeks of global demand. 6 weeks. For an industrial metal that takes years to bring new mine supply online. COMEX registered silver inventories, the metal that can actually be delivered against futures contracts, have collapsed 70% since 2020. We're now at levels not seen in over a decade, and delivery requests are accelerating. In early January alone, buyers took delivery of over 1,600 contracts in a single day, while open interest actually increased, meaning new buyers were entering specifically to take physical possession, not to speculate on paper price movements. The London Bullion Market Association reported in October that silver vaults held approximately 844 million ounces. That sounds like a lot, until you realize global annual demand runs around 1.24 billion ounces. So London's entire stockpile would satisfy about 8 months of consumption, except it's not all available for delivery. Much of that metal is already owned, sitting in allocated accounts, not available for new buyers. Meanwhile, silver lease rates, the cost to borrow physical metal for short-term delivery, have spiked above 7 to 8% for the 5th time this year. Historical lease rates hover near zero. When borrowing costs surge to 8%, that's the physical market, screaming that metal is unavailable at any reasonable price. Industrial users who need silver for manufacturing are paying 8% annualized just to access inventory for a few weeks. That's not a healthy, liquid market. That's a market in acute physical stress. India triggered a perfect example of this dysfunction in October when a buyer placed an order for 1,000 tons of silver, about 32 million ounces. The London market instantly froze. Lease rates spiked from 0.25% to 200% within hours. Swiss refiner Metalor, which operates in 17 countries, announced they would not return to normal operations until January 2026. One large order broke the entire pricing mechanism because the metal simply wasn't available, and India's appetite hasn't slowed. From September through October alone, India imported 2,600 tons, 83 million ounces. Over 10 months in 2025, India absorbed 170 million ounces, nearly double typical annual imports. This isn't jewelry demand that ebbs and flows with gold prices. This is industrial consumption, solar panel manufacturing, electronics production, demand that doesn't stop because paper prices crashed 30% in a day. Solar photovoltaic installations consumed 232 million ounces of silver in 2024, up fivefold from 2015 levels. Electric vehicle production, 5G infrastructure, semiconductor manufacturing, every technology driving the energy transition requires silver. There's no substitute for silver's conductivity in solar cells. You can't make a solar panel without it. And global solar installations aren't slowing down because silver had a volatile week in late January. Here's where it gets mathematically brutal for anyone still thinking this is just normal commodity volatility. The world produced approximately 1,010,000,000 ounces of new silver from mining and recycling in 2024. Demand reached 1,240,000,000 ounces. That's a 230 million ounce deficit. The fifth consecutive year consumption exceeded production. Over the 5-year period from 2021 through 2025, cumulative shortfalls totaled roughly 820 million ounces. That's nearly equivalent to an entire year of global mine production, just gone from above ground inventories. China's January 1st export licensing system removed another 60 to 70% of global refining capacity from international access. Only large, state-approved companies with annual production exceeding 80 tons can obtain export licenses. Small and mid-sized refiners are completely blocked. This is not a temporary trade restriction. This is China weaponizing silver supply the same way they did with rare earth elements, recognizing the metal's strategic importance for renewable energy and advanced manufacturing. The evidence of a two-tier market isn't subtle. During the January 30th paper price crash, physical silver premiums exploded. While COMEX futures settled at $78, you couldn't buy a 1-ounce coin from any major dealer for less than $95 to $105. In Dubai, coins were trading at $99.93 when COMEX March contracts closed at $72.265. That's a $27 premium, 38% over spot. When physical and paper prices diverge that dramatically, you're not looking at normal market friction. You're looking at a pricing mechanism that's completely broken. Institutional buyers know this. That's why they took delivery of 3 million ounces at the bottom while retail was being liquidated. They understand that COMEX and LBMA prices are increasingly fictional, determined by leveraged paper trading that has almost nothing to do with actual metal availability. The ratio of paper silver claims to physical silver backing those claims has been estimated as high as 356 to 1 at peak. For every ounce of real metal, there are 356 ounces worth of contracts claiming ownership. This is the exit plan the smart money has been executing while retail watches paper prices and tries to trade technicals. Accumulate physical metal when engineered paper market crashes create temporary discount. Ignore the narrative about bubbles bursting and fundamentals changing. Watch the lease rates, the COMEX registered inventory, the backwardation showing up in futures curves, the delivery requests accelerating month after month. Those signals show what's really happening. Physical silver is disappearing from the system while paper promises multiply. Scott Bessent testified yesterday that he supports strong dollar policy while refusing to protect Fed independence. Kevin Warsh will take over the Fed in May with a policy framework that simultaneously wants rate cuts and balance sheet reduction. And physical silver inventories are at multi-year lows while industrial demand keeps accelerating. These three forces are converging toward a crisis in pricing mechanism credibility that makes January 30th look like a preview, not the main event. Let me show you the math that makes the next 6 months inevitable, regardless of what Kevin Warsh decides about Fed policy or whether Scott Bessent can hold together the fiction of strong dollar orthodoxy. These are numbers that don't care about political narratives or central bank and independence debates. This is supply and demand operating at the most basic level, and the gap is widening so fast that no amount of paper market manipulation can bridge it much longer. According to the Silver Institute's World Silver Survey released in April 2025, global mined silver production is running at approximately 813 million ounces annually. Add in recycling, which hit a 13-year high but still only contributes about 200 million ounces, and you're looking at total supply around 1.05 billion ounces for 2025. That is actually up slightly from 2024, marking an 11-year high in total supply. So the supply side is doing everything it can to meet demand. Now here's where the mathematics become brutal. Total silver demand for 2025 is projected at 1.2 billion ounces. That's a deficit of approximately 95 million ounces for 2025 alone. The fifth consecutive year consumption has exceeded production. Over the 5-year period from 2021 through 2025, the cumulative shortfall totals 820 million ounces. That's nearly equivalent to an entire year of global mine output just gone from inventories. But that 95 million ounce deficit is the official number that accounts for traditional demand categories. It doesn't fully capture what's happening with investment flows through exchange-traded products. According to the Silver Institute, global silver-backed ETPs saw net inflows of 187 million ounces through November 2025. That metal is being taken off the market, stored in vaults, rendered unavailable for industrial users. When you add investment demand to the structural deficit, you're looking at an actual shortage approaching 300 million ounces for 2025. Now factor in China's export restrictions that went into effect January 1st. We've been talking about 60 to 70% of global refining capacity, but let me make that concrete. China accounts for roughly 15% of global mine production, but controls a dramatically larger share of refining infrastructure. The new licensing system requires exporters to demonstrate annual production exceeding 80 tons, 2.57 million ounces. Small and mid-sized refiners are completely shut out. Only large state-approved firms with track records of exports from 2022 through 2024 can even apply. Industry estimates suggest this could remove 120 million ounces from international markets annually. That's not a reduction in global production. That silver is still being mined and refined. It's just staying in China for domestic industrial use. Solar panel manufacturing, electronics production, EV components. China is prioritizing its own supply chain over export revenue. This is resource nationalism operating at scale, and it fundamentally changes the supply equation for every other country. So let's do the arithmetic that matters for 2026. Start with the baseline 95 million ounce deficit from traditional supply-demand imbalance. Add China's export restrictions, removing 120 million ounces from international access. You're now at 215 million ounces of shortage before accounting for any increase in industrial demand or investment flows. At current prices, around $80 per ounce, that's $17.2 billion worth of metal that needs to come from somewhere, and there's nowhere left to source it. Industrial demand isn't declining despite high prices. According to Silver Institute forecasts, industrial fabrication is on track to exceed 700 million ounces for the first time in 2025, with volumes projected to grow another 3%. Solar photovoltaic installations are expected to hit another record high in 2025, even with pressure on U.S. renewable projects under the new administration. Electric vehicle production continues accelerating globally. AI data centers require massive amounts of silver for server infrastructure and power distribution. These are not discretionary uses that disappear when prices rise. These are critical inputs for technologies that define economic competitiveness. Here's what forces the breaking point. According to TD Securities analysis from last fall, London's free float inventory, metal actually available for immediate delivery, had fallen to approximately 155 million ounces. That covers roughly 6 weeks of global demand. COMEX registered silver, the metal that can be delivered against futures contracts, has collapsed 70% since 2020. We're at multi-decade lows, and delivery requests are accelerating rather than slowing. Metal Focus projects the 2025 deficit at 63.4 million ounces, then narrowing to 30.5 million ounces in 2026. But those projections assume demand destruction from high prices and modest improvement in mine supply. What if prices don't destroy enough demand because industrial users literally cannot function without silver? What if solar manufacturers and EV producers keep bidding for available supply regardless of cost because their production lines stop without it? That's when you get the scenario major banks are now openly discussing. Bank of America raised its 12-month silver target to $65 per ounce in late 2025, citing narrowing real yields and strengthening ETF inflows. They project silver averaging $56.25 in 2026, with a peak at $65. Conservative estimate from a major institution that 6 months ago wouldn't have dared suggest silver above 40. But look at what the more aggressive forecasters are saying. Felipe Geisels, chief strategy officer at BNP Paribas Fortis, told CNBC he would not be surprised to see silver well north of $100 in the not-too-distant future. Citigroup analysts are projecting silver could reach $100 by March 2026, that's literally next month, and potentially $110 in the second half of the year. These aren't fringe commentators or gold bug newsletter writers. These are research desks at institutions that manage trillions in assets, making public calls that silver could double from current levels within months. Gold Silver's Alan Hibbard goes even further, stating he expects silver to perform better in 2026 than its 147% surge in 2025, suggesting prices could climb above $175. Michael Oliver, a veteran technical analyst, has outlined a scenario reaching $100 to $200 by early 2026. At some point, you have to ask yourself whether the consensus is wrong or whether something fundamental has shifted in how this market operates. Now let's talk about the timing mechanism that creates the volatility trap, because this is where retail investors get destroyed while institutions position for the real move. Kevin Warsh's confirmation hearing is expected in March 2026. He takes the Fed chair position in May when Jerome Powell's term expires. That's a 3-month uncertainty window during which markets have absolutely no idea whether they are getting the hawkish Warsh who opposed quantitative easing in 2011 or the dovish Warsh who's been advocating for aggressive rate cuts over the past year. During those 3 months, silver will trade in a range that frustrates both bulls and bears. Every hawkish comment from Warsh or Trump administration officials will trigger algorithm-driven selling as traders position for stronger dollar and tighter financial conditions. Every dovish comment about rate cuts or productivity gains will trigger buying as traders position for weaker dollar and easier policy. You're looking at a $75 to $110 range, massive percentage moves that create the illusion of trading opportunities while actually just chopping accounts to pieces through whipsaw volatility. But here's what doesn't change during that volatility: the physical deficit. Industrial users still need silver regardless of what futures prices do. Solar manufacturers still have orders to fill. EV producers still have production targets. Data centers still require build-out. The metal physically disappearing from inventories every week does not care about Kevin Warsh's confirmation testimony or Scott Bessent's dollar policy statements. So the smart money, institutions with physical delivery capability, entities that took those 3 million ounces at $78 on January 30th, they're not trading the range. They're accumulating through the volatility. Every time silver dips toward 75 on hawkish Fed fears, they're buying physical. Every time it spikes toward 110 on dollar weakness, they're holding and waiting for the real move. That real move comes when one of two things happens. Either Warsh's confirmation clears in March and policy uncertainty resolves, giving markets a clear direction to price, or physical inventories drain to levels where industrial users panic and start bidding aggressively for any available supply. My assessment is both happen simultaneously. Warsh confirmation coincides with late Q2 inventory crisis as solar manufacturers gear up for peak production season. When that break occurs, when silver decisively clears $90 and holds above it for the first time since the January crash, you're looking at initial target range of $125 to $135, as the metal reflects actual physical scarcity rather than policy uncertainty. This is the $90 breakout the title references. Not where we've been, but where we're going, once the Bessent-Warsh conflict resolves and physical shortage becomes the dominant narrative. That's where retail investors who sold at $73.50 during the January 30th crash start chasing back in, having missed the entire recovery. They buy at $140, convinced they're getting in early on the move to $200. But institutions that accumulated at $78 to $90 aren't holding for $200. They're watching for the parabolic phase, the blow-off move where price disconnects completely from fundamentals and starts trading on pure momentum. That hits somewhere between $180 and $220, probably in Q2 or early Q3. 2026, when the supply deficit becomes an undeniable crisis covered by mainstream financial media. That's when smart money exits into strength. They're selling their $78 physical positions at $190, locking in $112 per ounce profit, while retail is convinced silver is going to $500 because some YouTube commentator showed them a chart pattern. The blow-off top traps late buyers who entered above $140 didn't understand they were providing exit liquidity for early accumulators. Then comes the Warsh policy reality check, because regardless of whether he cuts rates in June, he's fundamentally committed to shrinking the Fed's balance sheet. That's been his consistent position since 2008, when quantitative tightening accelerates. In the second half of 2026, when the Fed starts selling bonds aggressively, long-term rates climb, dollar strengthens, and all dollar-denominated commodities face pressure. That's when silver crashes from whatever blow-off high it reaches, probably back toward 120 to 140 range, and institutions that exited at 190 are buying again for the next cycle. This is the exit plan operating over a 6 to 9 month time frame. Accumulate in the current $79 to $91 range that represents post-liquidation value with physical deficit support. Hold through the March-May volatility as Warsh confirmation creates whipsaw trading. Exit into strength when retail panic buys the breakout above 125. Let late buyers provide liquidity at 180 to 220, then step aside before the Q4 policy tightening crashes the momentum trade. The mathematical reality is that at some point, price must rise high enough to either destroy industrial demand or incentivize enough new mine supply to balance the market. According to industry analysts, that equilibrium price is probably north of $150, sustained over multiple years to justify the capital expenditure for new mining projects. Silver deposits take 7 to 10 years from discovery to production. There's no quick supply response available. So the gap between current $80 prices and $150 equilibrium represents the revaluation that has to occur. The only question is whether it happens gradually over 3 years or violently over 3 months, when inventories fully drain and industrial users realize they're facing actual supply interruptions. Based on the pace of inventory drawdowns, the acceleration in delivery requests, and the tightness shown in 8% lease rates, I'd wager we're closer to the violent scenario than the gradual one. For everyday Americans watching this unfold, understand what you're actually seeing. This isn't a bubble or speculation or retail traders getting taught a lesson about leverage. This is the paper pricing mechanism for a critical industrial commodity breaking down in real time, because the promises made through futures contracts can't be fulfilled with actual physical metal. When paper and physical prices diverge by 30 to 40%, like they did on January 30th, when lease rates hit 8%, when COMEX registered inventory collapses 70%, you're watching a market structure that's failing to perform its core function of price discovery. The exit plan for institutions is to profit from that breakdown. Buy physical when engineered volatility creates temporary discounts. Exit when retail panic creates artificial premiums. The exit plan for retail should be understanding you're playing a different game entirely. You don't have Fed credit lines, authorized participant status, or physical storage infrastructure. You're trading against entities that can influence the margin requirements, time their liquidation triggers, and take physical delivery at will. If you're holding physical silver you purchased for long-term value preservation, none of this volatility matters to you. You're not trading, you're storing wealth in a form that maintains purchasing power through currency debasement and financial system instability. But if you're trading silver futures or leveraged products, understand that every margin requirement, every Warsh policy statement, every algorithm-triggered cascade is a tool that benefits players who understand the timing mechanisms you don't. We're 6 days past the January 30th crash. Silver is at $80 after recovering from $73.50 and giving back gains from $91.72. Warsh confirmation is 6 to 8 weeks away. Physical inventories are at multi-decade lows. Industrial demand is accelerating. China has locked down export capacity. Scott Bessent is trying to maintain strong dollar fiction while refusing to protect Fed independence, knowing that Warsh's balance sheet policy will strengthen the dollar and destroy Treasury's manufacturing agenda. Kevin Warsh is positioning to cut rates and shrink the balance sheet simultaneously, creating the exact dollar strength that makes Bessent's nightmare scenario inevitable. These are the conditions that create not just volatility, but structural breaks in how markets function. January 30th showed you the mechanism in miniature. Margin requirements trigger liquidations that create temporary price dislocations, while physical market shows completely different dynamics. Scale that up to a multi-month inventory crisis with policy uncertainty overlay, and you get the setup for moves that make 147% annual gains look conservative. The only question that matters: do you understand which side of the exit plan you're on?